So, if you've been scrolling through financial headlines recently, maybe you've seen some nervous chatter about a potential market crash.
Yeah, often tied to a very specific date, October 29th. Kind of spooky.
Right. And that date, for anyone who knows their history, it isn't just random, is it?
No, not at all.
Mm.
It's an immediate echo of Black Tuesday, October 29th, 1929, probably the single most devastating day in American financial history.
Okay, so let's be clear. We're not here putting on tinfoil hats, definitely not predicting the future.
No, absolutely not.
But we are going to take a deep dive into what actually happened back in 1929.
Yeah, our goal here is really about risk management. It's about dissecting that catastrophe, pulling out the tough lessons learned.
And applying them to you, right, the
Yeah.
modern investor, helping you figure out how to protect your portfolio, maybe keep your peace of mind when, things inevitably get volatile.
Exactly. Because, look, history doesn't repeat exactly, but human psychology, that tends to rhyme. If we understand the forces behind 29, we can spot similar things maybe hiding in plain sight today.
Okay, so where do we start? I guess we have to set the scene, the psychology of the time.
Oh, absolutely. You have to understand the roaring 20s.
Right. Post-World War I America, things were absolutely buzzing.
Totally. New technologies were exploding onto the scene: radios, mass-produced cars, electricity spreading everywhere. It was fundamentally changing daily life.
Yeah.
And productivity was just soaring.
And that created this powerful feeling, didn't it? This mindset.
Historians call it the new era mentality. It was this almost unshakable belief that America had hit some kind of permanent plateau of prosperity.
And crucially, that the stock market could only go up forever.
Precisely. It wasn't just optimism, it was this deep, profound overconfidence, and frankly, pretty dangerous.
Dangerous because that belief fed directly into the first big parallel we need to talk about: easy money and leverage, just astronomical leverage.
Yeah, let's unpack how that actually worked, how people were buying stocks back then.
Okay.
The main mechanism was called buying on margin, and, well, by today's standards, it was just unbelievably reckless.
How reckless are we talking?
An investor often only needed to put down maybe 10% of the stock's value, sometimes even less.
Wait, only 10%. So if I wanted, say, $1,000 worth of stock.
You'd put up $100, your broker would just loan you the other $900.
Yeah. A 10% down payment on stocks? I mean, how is that even allowed? That level of leverage seems insane.
It was completely standard practice,
Mhm.
and yeah, it fueled this massive speculative boom because, look, if the stock went up 10%, you doubled your $100 investment instantly. The gains felt incredible, addictive even.
Ah, okay. I see the appeal. But the downside?
The downside was brutal. It was a financial time bomb. If the stock dropped just 10%, poof, your entire $100 investment was wiped out.
Gone. Just like that.
And worse, you'd immediately get hit with a margin call, your broker demanding you deposit more cash right now.
Or what?
Or they'd forcibly sell your stocks at whatever price they could get, which in a falling market could be disastrously low, leaving you not just broke, but potentially in debt to the broker.
So you had millions of ordinary people, not just investing, but essentially taking out huge, instantly callable loans backed by really volatile assets.
Exactly. The whole system was just incredibly fragile, built on a house of cards, really.
And that fragility, I guess, was made even worse by this second big psychological thing happening, this speculative frenzy.
Oh, completely. Investors had pretty much stopped thinking about the actual value of the companies they were buying.
So they weren't looking at things like, profits or earnings or future prospects.
Barely, if at all. It was pure greater fool theory in action.
Explain that, the greater fool theory.
It's simple, really. You buy something, anything,
Yeah.
not because you think it's worth the price, but because you're confident some other fool, a greater fool, will come along tomorrow and buy it from you for even more.
Detached from reality, basically.
Totally detached. It pushed valuations into the stratosphere. You had PE ratios, the stock price compared to the company's yearly earnings, soaring to like 30, 40 times earnings. That's not investing, that's just mania.
And that explains those almost legendary stories you hear, right? About janitors, school teachers, everyday folks pouring their life savings into the market.
Yeah, everyone felt they had to be in it. They genuinely believed they were on the cusp of becoming millionaires. It was this widespread, almost compulsory participation.
And it all kind of peaked, didn't it? That overconfidence.
It really did. There's that famous quote from President Herbert Hoover, right when he took office in March 1929. He said, "We in America today are nearer to the final triumph over poverty than ever before."
Wow. Talk about famous last words. That really marks the peak, doesn't it? Right before it all unraveled.
The ultimate signal of peak confidence, yeah. But the cracks started showing just a few months later.
Okay, let's walk through those final fateful days. It started on a Thursday, right? October 24th, Black Thursday.
That was the first real break.
Yeah.
Panic selling started. And as prices dropped, all those margin calls we talked about, they just exploded across the system.
The volume must have been insane.
Completely overwhelming. The ticker tape, the machine recording the trades, it fell hours behind the actual trading on the floor. Imagine the uncertainty, the fear that caused.
Total chaos. But I remember reading that some big bankers tried to step in.
They did. Figures like J.P. Morgan Jr. and others pooled a significant amount of money, made very public purchases of major stocks to try and stabilize things, show confidence.
And did it work? For a bit.
It calmed things down temporarily. Over that weekend, there was maybe a sigh of relief, a feeling that maybe the worst had been averted.
But it was just a pause.
Just a pause. That intervention only delayed the inevitable. The selling came back fiercer than ever on Monday, October 28th. That was Black Monday.
How bad was that day?
Really bad. The Dow Jones Industrial Average dropped nearly 13% in a single session. Any confidence that had been restored was just gone.
Which brings us to the big one. Tuesday, October 29th, 1929. Black Tuesday.
Yeah. That was pure, unadulterated chaos on the New York Stock Exchange floor.
Sell orders just flooding in.
A tidal wave. The ticker tape lagged hopelessly behind again. Brokers were shouting, desperate. There were virtually no buyers stepping up, just sellers trying to get out at any price.
What were the numbers like that day?
A record-shattering volume, 16.4 million shares traded, which might not sound like much today, but back then it was unprecedented. And the Dow, it collapsed another 12%.
Billions just vanished.
Instantly. And because of that 10% margin system, remember, those margin calls didn't just cause losses. They completely wiped out the life savings of millions of people who had borrowed to invest.
Okay, this is a really important point, something the sources emphasize. Black Tuesday, as horrific as it was, wasn't actually the end of the crash, was it?
No, absolutely not. And that's a crucial misunderstanding many people have. It was the most dramatic day, the turning point maybe, but the collapse itself was this slow, grinding, relentless process.
It kept going down. For how long?
For years. It dragged on and on, ultimately leading into the Great Depression. We have to grasp the sheer scale of the destruction.
Give us a sense of that scale.
By the summer of 1932, so nearly 3 years after Black Tuesday, the Dow Jones was down almost 90% from its peak in 1929.
90%.
90%. Let that sink in. That's not just a market correction. That's the obliteration of economic life, of confidence for an entire generation. It's hard to even imagine that level of sustained loss today.
Truly terrifying. And the lesson there isn't just that markets can crash, but that when a boom is built on that kind of leverage and speculation, the bust can be incredibly deep and incredibly long-lasting.
Precisely.
So fast forward to today. We see the headlines, we feel the echoes. The obvious question is, could it happen again? Are we just doomed to repeat this cycle? If the system was so fragile then, should we be terrified now?
Well, we should certainly be vigilant. Always. But look, we can say with some confidence that we are not living in the exact same financial world as 1929.
Because things changed. Regulations came in.
Exactly. Crucial safeguards were put in place precisely because of the nightmare of the 1920s crash and the depression that followed.
Okay, walk us through the big ones. What key structures exist now that didn't exist then?
Well, first off, you've got the SEC, the Securities and Exchange Commission, created directly in response to the crash. Its job is to prevent fraud, ensure companies are transparent in their reporting, basically making sure investors have a clearer idea of what they're actually buying.
Right, trying to stop outright manipulation and misinformation. What else?
FDIC insurance, Federal Deposit Insurance Corporation. This insures your deposits in banks up to a certain limit. This was absolutely massive.
Why was that so critical?
Because it stopped the bank runs. In the 1930s, fear alone could cause a bank to collapse. People would panic, rush to withdraw their cash, and even healthy banks could fail. FDIC insurance removes that incentive to panic. Your money is protected.
Okay, that makes sense. Stops a contagion. What about on the market trading side itself? You hear about things like circuit breakers.
Yeah, those are important too. Modern stock exchanges have automatic trading halts. If the market drops too far, too fast, say 7%, 13%, 20% in a day, trading just stops for a period.
What's the point of that? Does it really stop a crash?
The idea is to interrupt the panic cycle. Give everyone, traders, systems, investors, a moment to breathe, process information, maybe prevent purely emotion-driven selling from spiraling completely out of control.
I wonder though, doesn't that sometimes just build up the pressure for when trading resumes? Is it a tech fix for what's fundamentally a human fear problem?
That's a really critical question, actually.
Uh,
Circuit breakers can slow the speed of a crash. They can mitigate the sheer velocity of the panic, but they can't by themselves prevent a market decline if the underlying reasons, bad fundamentals, genuine economic fear, the unwinding of leverage are still there. They manage the chaos, they don't eliminate the cause.
got it. And there's one more big player now, right? The Fed.
Absolutely. The Federal Reserve today is a much more active and powerful institution than it was in 1929. It acts as a lender of last resort. It has a whole toolkit of monetary policy levers, interest rates, quantitative easing, and a mandate to try and stabilize the financial system and the broader economy. That kind of active intervention framework just didn't really exist back then.
Okay, so the basic plumbing, the architecture of the financial system is definitely stronger, less prone to sudden catastrophic failure like in 29.
Yes, generally speaking, that's true.
But, and this feels like the big but, we talked about human nature earlier. Has that changed?
Not one bit. And that's where the parallels, despite the safeguards, start to feel a bit, well, hauntingly familiar. The underlying drivers, greed, fear, speculation, they find new ways to express themselves.
So let's connect the dots. The 1920s had easy money through those lax margin rules. What's the modern version?
Well, think about the last decade or more. We had near zero interest rates for a very long time. Plus, quantitative easing, the Fed pumping trillions into the system. That was a different kind of easy money. But it certainly flooded the markets with liquidity, arguably encouraging risk-taking.
Okay, so maybe not 10% margin on regular stocks, but where does that excessive leverage pop up today?
It's shifted. You see it in things like leveraged ETFs, exchange-traded funds designed to amplify daily market moves, sometimes 2x or even 3x.
So if the market goes up 1%, the ETF aims for 2% or 3%.
Exactly. But the flip side is brutal. If the market moves against you, your losses are instantly magnified by that same factor.
Sounds like margin lending in disguise.
It functions very similarly in terms of amplifying risk.
Yeah.
And then you have the explosion in retail options trading, especially short-dated options like weeklies.
How is that leverage?
Options allow you to control a large amount of underlying stock with a relatively small capital outlay. If you're right, the percentage gains can be huge. If you're wrong, especially with short-term options, you can lose your entire premium very, very quickly. It's concentrated leverage, pure and simple. It has that same potential for instant, total loss that the 1929 margin speculator faced.
Okay. And what about the other psychological driver, that greater fool speculative frenzy? Where do we see that today? Completely detached from, actual company value.
Oh, come on. We've had some textbook examples recently, haven't we?
You're thinking meme stocks.
Absolutely. The meme stock craze of 2021, GameStop, AMC, others, their valuations weren't driven by balance sheets or revenue forecasts. They were driven entirely by social media hype, online communities, this collective narrative completely separate from fundamentals. That is pure greater fool theory.
Just betting that the Reddit crowd would push it higher.
Pretty much. And you could argue the same psychology fueled parts of the crypto boom and bust cycles. Or think about the NFT mania for a while there.
Mm-hmm. Right. Digital beanie babies, some called them.
The specific asset changes stocks, digital tokens, digital art. But the core human behavior, buying something solely because you think someone else will pay more for it later, regardless of intrinsic worth, that is identical to 1929.
And the final piece, that new era, overconfidence, the belief that things can only go up.
We definitely saw shades of that during the long bull run after the 2008 crisis. This pervasive feeling emerged that stocks only go up. Maybe dips happen, but they're always buying opportunities.
Tina, there is no alternative.
Right. And coupled with that, this almost ingrained expectation that the Federal Reserve will always step in. The idea of the Fed put, that the central bank had your back and will bail out the market if things get too rough.
So a belief in perpetual safety, underwritten by the authorities.
That expectation of constant intervention and rescue, that feels very much like the 21st century version of Hoover declaring we'd conquered poverty. It breeds complacency, encourages risk.
So the sobering lesson seems to be, regulations can make the system more robust, protect the banks maybe, but they can't ultimately protect individual investors from their own psychology, from greed, from fear, from bad decisions.
Exactly right. Which brings us neatly to the really practical part of this. What do you do about it?
It's the action plan.
Yeah. If you're listening to this and feeling a bit worried about market volatility, maybe echoes of 1929, the answer isn't to try and predict the exact date of the next crash. That's a fool's game.
So what is the answer?
Preparation. building resilience into your portfolio before the storm hits.
Okay, let's break down the key lessons. Learning from those who got completely wiped out in 1929. What's lesson number one?
First, and honestly most importantly, beware of leverage. Full stop.
Simple as that.
Simple as that. The single biggest factor that destroyed people financially in 1929 was debt used for speculation. Margin loans. Minimize it. Or better yet, eliminate margin borrowing and complex leverage products from your core long-term portfolio.
Because leverage doesn't just magnify gains.
It magnifies losses. And crucially, it forces your hand. Leveraged investors have to sell when things go bad because of margin calls. They get forced out at the worst possible time. Non-leveraged investors have the option to wait.
Okay, critical point. Lesson number two.
Diversify. 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 Yeah, it sounds like a cliche, but it's a cliche for a reason, especially thinking back to 29.
Why, especially then?
Because the crash wasn't just one sector. The entire stock market was caught up in that speculative leveraged bubble. But other assets behave differently. Having your money spread across different kinds of investment stocks, yes, but also bonds, maybe some real estate, crucially some cash, provide the cushion. When one thing tanks, hopefully not everything tanks at the same time or by the same amount.
Makes sense. Spread the risk. What's number three?
Invest for the long term. And, importantly, only invest money you can afford to leave invested for the long term.
Time in the market beats timing the market.
That's the principle. But you have to be realistic about the time part. Remember that horrifying stat. It took 25 years, 25, for the market just to get back to its 1929 peak.
Wow. That's a lifetime for some investors.
Exactly. So any money you know you'll need in the next 5, maybe even 10 years for a house down payment, for tuition, for retirement income, that money probably shouldn't be exposed to the full volatility of the stock market, especially speculative parts of it. You need a time horizon that can withstand a potentially long recovery.
Crucial advice. Okay, and the final lesson, number four.
Tune out the noise.
Yeah.
Seriously. Especially the short-term noise.
Easier said than done sometimes.
Oh, absolutely. We're bombarded. Headlines screaming about a crash on October 29th. That generates clicks. Not useful investment strategy. Financial TV, shouting heads, endless social media hype and fear.
It pushes emotional buttons.
Exactly. It encourages the exact kind of reactive, panic-driven selling or FOMO-driven buying that destroys long-term plans. You need a solid plan based on your own goals and risk tolerance, and then you need the discipline to stick to it, regardless of the daily chatter.
Build the plan, trust the plan.
Pretty much. The key to navigating any downturn, whether it's a correction or something worse, is having built that resilient portfolio and cultivated a patient mindset beforehand. So you're not forced into bad decisions when fear is peaking.
So, wrapping this up, the ghost of October 29th, 1929, it isn't really here to tell us what will happen next.
No, it's a teacher, not a crystal ball.
It teaches us that markets move in cycles, right? That human psychology swinging between greed and fear is a constant driver, and that booms built on shaky foundations, on excessive leverage and pure speculation, they just aren't sustainable.
They inevitably lead to busts. And the best way, really the only way, to be ready for that isn't prediction. It's preparation. It's patience. It's having that sober understanding of history.
And building that resilience today, in your portfolio and in your mindset.
Exactly.
Okay, let's leave our listeners with a final provocative thought, drawing directly from that history. The people who suffered the absolute worst, the truly catastrophic losses in 1929 and the years after, they were the ones who, because of leverage, needed to sell. They were forced out at the bottom.
Yeah.
So the question to ask yourself right now is, if an absolute worst-case scenario happened, maybe not 90% down, but a deep multi-year bear market, what parts of your current investment portfolio could you genuinely afford to hold without selling for maybe 5, 10, even 20 years if you absolutely had to?
That's a tough question.
It is. But the honest answer to that question really reveals your true level of risk exposure today, far more than any market prediction ever could. Something to really think about.